Introduction to real estate financing. Financing, for our purposes, is receiving or providing money for the purchase of real estate. Getting a loan for the purchase of real estate usually follows the same steps. The buyer applies to a lender for a loan. Usually this happens before the buyer begins looking for a property to purchase, in which case the buyer will receive approval for the loan as a pre-approval or pre-qualification. The lender assesses the buyer's ability to pay for the loan by looking at their gross salary, used to determine their debt-to-income ratio, and their credit history, FICO score. Lenders also use capacity, capital, collateral, and credit to assess a buyer's ability to repay a loan. Assuming the buyer begins the loan process before looking for properties to purchase, the buyer receives a pre-approval letter from the lender. This commitment is not necessarily binding on the lender and is contingent on the buyer finding a property that is worth enough to cover the loan amount. Some lenders will call the pre-approval letter a commitment letter or a letter of commitment, but for most lenders, the letter of commitment comes after the loan underwriting process is complete. The buyer finds a property they want to purchase, and the lender hires an appraiser to determine if the collateral, the property, for the loan is sufficient to cover the loan in the event of a default, failure to make payments. If the collateral is insufficient to cover the loan, the buyer will typically need to make a larger down payment or back out of the sale. The lender's attorney checks the public records at the county registry of deeds to determine if the property suffers from any title defects. If it does, the seller must fix them before the closing. Assuming the lender is satisfied with the collateral, they give a letter of commitment to the buyer. This requires them to make a loan, so long as the buyer satisfies the lender's conditions stated in the letter. At closing, the lender makes the loan for the borrower. In return, the borrower gives a note, also known as a promissory note or mortgage note, as evidence of the debt, along with a mortgage securing the debt to the lender. Ideally, the buyer pays back the loan over some of the years. Upon repayment, the lender returns the note and the mortgage to the buyer, and the buyer owns the property free and clear. Alternatively, if the buyer fails to pay off the loan, or if they default on the loan, the lender forecloses on the property in order to secure payment. Foreclosures. If a borrower does not repay their loan in accordance with the loan's terms, the lender can initiate a foreclosure to recover the money that they are owed. In a foreclosure, the lender takes possession of the collateral for the loan, typically the house, and sells it. The proceeds from that sale are used to repay the loan balance. Foreclosures are usually judicial, but some states permit non-judicial foreclosures if a deed of trust was used for financing arrangement instead of a mortgage. Foreclosure sales are usually done by public auction. At the auction, the lender grants the title to the highest bidder, which may be and often is the lender itself, by signing and delivering a new deed. If prior to the auction the borrower has the ability to pay the lender what they owe plus the costs of the foreclosure, they can prevent the foreclosure by exercising their equity right of redemption. A lender might also agree to a loan modification where the loan is changed so that the borrower can afford to make payments and avoid foreclosure. There are several issues to be aware of when buying foreclosure properties. If the property has been vacant, there could be issues with lack of maintenance or damage. The previous tenants or owners may have damaged the property on their way out of the property, or thieves may have taken advantage of the unoccupied property. Stolen pipes for scrap metal, vandalism due to anger, graffiti, etc. And on the other hand, if the property is still occupied by the tenants or homeowners, then it would require starting an eviction process. Since most of the properties are as-is sales, there are no seller's disclosures, and often an inability to inspect or review the property. In fact, there might not even be a home inspection or any way to visually assess the interior of the property. There may also be title issues and other liens, such as unpaid taxes, water bills, mechanics liens, etc., associated with the property. Because of all of this, financing for foreclosures can be challenging due to the property being potentially inhabitable or having low appraisal value. Another way that a homeowner might avoid foreclosure is a short sale, where the homeowner sells the home short of what they owe to the bank. This typically happens if a homeowner is underwater, meaning they owe more than they can sell their home for. A short sale is effectively a settlement with the bank where the bank agrees to accept less money to pay off the loan than they are owed. Usually, this amount is more than the bank would likely be paid for the foreclosure auction, which is why they might agree to it. In a short sale, the bank settles with the homeowner for whatever sales price the homeowner can obtain on the open market and writes off the remaining loan balance as a loss. Real estate agents often help homeowners sell their home in a short sale, though the process can take quite a bit of time due to the need for bank's approval of any offers. One of the biggest issues when dealing with short sales are the delays. The lender must sign off on the purchase price, and depending on the lender, this can either be a straightforward process or an entire mess. Part of this is because the first lien holder, or first mortgage, has to get consent from all other lien holders. For example, HELOCs, judgments, tax liens, etc. in order to approve the short sale. Then there are other issues such as cloud zone title, like unpaid taxes, water bills, and mechanics liens, to mention a few. Delays can also occur because the seller has to prove that their financial situation requires a short sale. Then there are also tax implications for the buyer. When the bank writes off the loss, it shows up as income for the buyer. This means the buyer can get slammed with taxes on debt forgiveness. This was a huge problem for people, so the Mortgage Forgiveness Relief Act of 2007 was passed by Congress to help alleviate this issue. The act excluded up to $2 million in debt as income for short sales if certain conditions were met by the buyer. If the proceeds from a foreclosure auction are in excess of the borrower's debt plus the lender's expenses, the borrower will receive their leftover equity. On the other hand, if the auction fails to cover the debt and the lender's expenses, the borrower is personally liable for the deficiency and can be sued for the outstanding debt by the lender, resulting in a deficiency judgment. That said, lenders rarely pursue homeowners for the deficiency in residential foreclosures, and the lender most often loses any money they are still owed after the foreclosure auction. If the lender owns the property after foreclosure, they will sell it on the market as REO, or real estate owned property. Note that some states also provide strict foreclosure. In those states, an auction may not be required. The lender can sue the borrower, and if the borrower does not pay what they owe within the time frame ordered by the court, the lender receives the title to the property automatically. Usually, this is what's used for underwater properties, which are properties that are worth less than what is owed on the loan. The note and the mortgage. Real estate financing involves two legal instruments, the note and the mortgage. The note. The note is evidence of the debt. Think of it as an IOU. A promissory note typically contains all the terms involved, such as the principal debt amount, interest rate, maturity date, payment schedule, the date and placement of issuance, and the borrower's signature. Essentials of a valid promissory note: must be in writing, must be signed by the borrower, parties must be named, any interest mentioned, include date of issue and maturity date, must be stamped, define whether this is notary or not, total amount to be repaid, legal composition of payment noted, defining what it is. Be aware of the two clauses that might appear in the note. Acceleration clause permits the lender to accelerate the maturity date or due date of the loan in the event of a default on the terms of the mortgage. This is called calling in the note, and it is the lender's first step in the foreclosure's process. A prepayment penalty clause requires the borrower to pay a penalty for prepayment of the loan. It is used to guarantee that the lender gets paid the interest on the loan. Prepayment penalty clauses are uncommon in residential loans, but are very common in commercial loans. The mortgage. The mortgage is a security for the note. It provides a piece of property as collateral for the loan. Under the mortgage, the borrower hypothecates their property, which means gives it up as security while retaining it in possession. Depending on if a state is a lien theory state or a title theory state, either the bank, which is title theory, or borrower, which is lien theory, will hold the legal title during the life of the loan. Under the loan, the borrower in a title theory state has equitable title, a future right to gain legal title. Intermediary theory states, like Massachusetts, apply lien theory until there is a default on the mortgage. Then title theory is applied. The deed of trust lists the borrower, the lender, and a third-party trustee. The borrower retains the title, but the bank can take it back without any judicial proceedings by proving to the trustee that the borrower has defaulted. When the lender requests foreclosure to begin, the trustee can take over the property and sell it on the behalf of the lender. Some common features of mortgages are mortgage covenants, everything the borrower promises to do, make monthly payments, make their property taxes as impounds to the bank, meaning escrow funds paid to the bank by the borrower that the bank uses to pay any property taxes owed on the property so that the borrower doesn't fail to pay their property taxes and get foreclosed on. Keep the property insured, etc. Power of sale clause permits the lender to take property and sell it in the event of a default on the terms of the loan, most often non-payment of the loan. Defeasance clause. When the loan is paid back, the bank's claim to the collateral is automatically relieved. Due on sales clause or alienation clause permits the bank to accelerate the maturity date of the loan in the event of most but not all title transfers, which prevents transferring the mortgage to a third party. Under Garn St. Germain Act, The due on the sale clause cannot be triggered upon death, devising of the property, leasing, marriage, divorce, or transfer to a family trust. Subordination clause makes the mortgage junior to any future mortgage. Junior mortgages that get paid second, third, or fourth, etc. in a foreclosure auction after any senior mortgages. You will see junior mortgages commonly referred to as second mortgages, or third mortgages, or fourth mortgages. You get the idea. Partial release clause, used in blanket mortgages that cover several parcels of land. This causes a release of a portion of the collateral in exchange for partial payment of the loan. Might be seen in a division developments or cross-collateralized loans. Points. A point is 1% of a loan. Points are often used to increase the value of a loan. Basically, if the interest rate on a loan is so low that it isn't worth making, a lender can charge the borrower points as an originated fee or a fee for getting the loan to increase their profit on the loan and make it worthwhile to them. A property was sold for $100,000 with a loan of $80,000. The lender charged the borrower 2 points. How much did the points cost the borrower? Which would be $80,000 multiplied by 0.2%, $1,600. Discount points. A borrower can use discount points paid up front to buy down the loan interest rate. This means the borrower owes less interest every month because they have paid some of the interest up front, which reduces their monthly payment. And mortgage brokers. Mortgage brokers are third parties that do not originate the loan, but instead broker the loan between the mortgage and the lender. They are not the same as mortgage bankers who work directly for the lender and do originate the loan. Mortgage brokers may offer more and more flexible option loans for clients by comparing different banks' offers through often a higher cost, though often provided at a higher cost because the broker charges a fee. Okay, so that was intro to real estate financing.